So I guess you guys have been given a bit of a bio on me. I'm the partner who oversees the investment side of the business at Crown Realty Partners. We're a private equity shop based in Toronto and focus on commercial real estate investing across Canada. We were founded in 2001, and we're basically a sort of mixture of a number of entrepreneurs who joined forces with an insurance company. And the insurance company acted as a little bit of a backstop investor to facilitate transactions. If you guys can all hear me okay, I'll shift over. I'll put our PowerPoint on, and let me see if I can successfully do this. Share screen, PowerPoint, and share. I hope I'm sharing the right thing.
Looks good.
I'm gonna put it on there in a sec, the full slide. So I'll just move along with my presentation. And again, guys, feel free to interrupt it at any point you guys would like. So what I've got here is basically a summary of just who are we, who is Crown. As I said, we're a private shop, and we have around just under $3 billion now of assets in terms of real estate value of assets under management. That amounts to a little bit over 7 million square feet of office space primarily. Within that space is around 700 tenants, and our firm has about 100 employees. The bulk of them are actually building staff, and about a quarter of the employees are sort of corporate accounting and corporate staff. This is a little bit of a diagram to sort of show what we do and the way that we, how we function. Many investment and asset managers here would typically just allocate, and one of the differentiating factors of what we do is that we are vertically integrated. We deal with every aspect of the assets. So beyond asset management, we're working on project management, construction management, sourcing the transactions, and as well as actually investing. So we have internalized construction managers, property managers, leasing managers, et cetera. And that's really a key differentiator for us relative to many of our peers in the industry. The other thing that matters a lot to the types of investors that we have, who are mostly institutional investors, is the fact that we, all of the partners, co-invest in any of the opportunities that we bring. The opportunities that we bring happen to be limited partnership funds, and we can talk more about that structure because I understand it's perhaps a structure that you guys don't see a lot of in your market. So into the limited partnership funds. As I mentioned, we started back in 2001, and at the time it was this partnership that was a number of entrepreneurial people coming together with something that was very institutional. And the institutional provided us with the original money to lock up transactions. And back then, at the time, we would identify opportunities, tie them up, and then call everybody for money to put the deal together, basically syndicating deal by deal. And of course, as you guys who are in the industry have probably seen, it's challenging to do that. You can't necessarily tie transactions up for that as long as you need to try to get the money behind you. So Crown established a reputation, made some money for investors, and after about 5 years, we did end up graduating, I'd say, to a fund model, which involves which sort of shifted us away from this syndication of individual deals into being able to actually have investors commit their capital to us. It was credible commitments, so we knew that we could call that capital whenever we would find a transaction. So it's a great concept if you can get the trust of investors. This is just a little timeline of our funds that we've had. So as I said, 2006, we graduated to this fund model and raised our first limited partnership fund. It's a closed-end fund, which means that there's a certain timeline in which to invest the money and a certain timeline in which to reap the rewards of that investment. The first fund was a smaller one. We raised $74 million of equity. And then we continued to raise subsequent follow-up funds basically every 3 years thereafter. Fast forwarding to today, where we currently have a $234 million fund. We're just at the tail end of it with a little bit of capital left to deploy, and are planning on marketing our fifth fund. Sort of COVID aside, we plan on having a closing sometime this year, likely at the beginning of the fourth quarter.
Can I interrupt with a question?
For sure. Yeah.
I assume that some of the funds were liquidated. Since it's a closed-end fund, it means it has a time limit. So exactly. when you had to liquidate the fund, did you actually bought your assets with the new fund, or you sold it to third parties, whatever?
Question. Actually, we sold all of the assets to third parties. So Fund 1, for example, where we produced a net IRR of 16%, just over 16%, we fully divested of all of those assets and sold assets at the time that it made sense for each asset. So it was quite staggered. The second fund as well, we did a little bit better, had the benefit of some assets that had been acquired at the very beginning, just fresh off of 2008. Shakeup, and achieved a 20% IRR. Our third fund, we're tracking 18% net IRR to our investors, and we've sold all assets except for 3. We had intended to put one of those assets on the market this year, but are probably sitting aside just to see what the market holds post-COVID. So you're totally correct. We dispose of the assets. We do have the ability to extend the timeline of the funds, and we're not compelled to sell immediately. But we do look at asset by asset and decide the time that makes most sense when to sell. Our investors would be very much against disposing of the assets and selling them to another fund. And many of them, when we do sell them, are quite stabilized. We take these assets that have a lot of friction in them and need a lot of repositioning to them, and then we'll stabilize them to an institutional quality. So it would be kind of hard to try to achieve the value add returns that we'd be seeking if we were to buy any of those assets going forward. Hope that
Emily, can you tell us more a little bit about the structure, how this works, who are the investors? When you open a fund, how long does it, do you set a date when this fund would start the investments, and no more money could come in anymore? And who are the investors? How much do I need to invest, or how much does one needs to invest? What's the minimum investment, et cetera, et cetera?
Awesome. Okay, this is great. I like these questions. So a minimum investment in and the minimum has changed over the years as the fund size has got bigger. The minimum investment size for our next fund going forward is $20 million. In order to participate on our advisory or investment committee, it's another threshold that would have to be achieved, $40 million. The investors currently within our fund are all Canadian institutions. I'd say they are pension plans. In some cases, there's a publicly traded MIC, a mortgage fund within our group of investors. And we also have a couple of very prominent families who basically have the equivalent of a pension plan. It's just a private pension plan for family members. So they range in size from around $4 billion of assets to $75 billion. So there, many of the pension plans or groups, many of these groups have their own real estate arm and invest in assets, in real estate assets directly, but they also look to us to get a little bit of extra returns through a value add strategy, and sort of pooling of capital with other like-minded investors. The other question I guess you had was about the timelines.
Right, right.
So typically with these closed-end LPs, what we would do is have, we'd raise the capital and have a 3-year period. That's the commitment period to invest the money that they said. So if they say we want to invest $40 million, we say, okay, that's great. We start hunting for assets and we stagger. We'll usually over the span of 3 years, we'll put out that money. So over time, we will call capital and it's pretty much equally distributed. So we'll say the first year, $40 million investor, give us around $12 million of equity. We have this great opportunity. Here's what it is. Because they're institutional investors, there's a lot of governance and reporting and oversight, not unlike what one would see at a publicly traded company. So I actually left a publicly traded company and was quite happy to move into the private sphere, thinking, oh, that's it. No more annual reports, no more management information circulars, none of that. And you know, the reality is we still live quarter by quarter. Our finance group lives quarter by quarter. So I know many of you are private investors, it seems, from the intros. So I think I'm not telling any of you anything that you don't know with this graph. I thought it was kind of interesting because this plot actually shows Canadian REITs, the line plot, and the fluctuations in the Canadian REIT index, which are an extremely popular way of investing here in real estate, with the shaded area being the range of net asset values of the actual underlying real estate that's owned. And so basically this was all pre-COVID. Now in that month post-COVID, pretty much the 10 years of REIT growth that had taken place has now dissolved within that 10 years. And it's since actually balanced off and gone and recovered quite well. But obviously the reason for us existing is that, you know, private real estate funds such as ours allow you to actually invest directly in real estate. And as I said, many of these investors, you know, would hold very core, stable, good quality assets on their own. They have their own real estate groups. And those types of assets don't really require as much handholding. They provide a stable distribution, a stable yield that balances well with payouts that they might have to make as pension plans, but it doesn't get them enhanced sort of outperformance. And so they come and give us their little amount of money and reinvest it in the hopes to sort of exceed their, you know, whatever metrics they're holding themselves accountable to, like the MSCI or IPD index or other things. So we try to help get that enhanced return. In that limited partnership structure, I guess, not sure if you guys know, but I just sort of am taking a step back. We as partners are all co-investors. We're private groups that invest with these institutional groups. We're known as the general partner. We have basically unlimited liability, and the other investors within the fund, the institutional investors, have limited liability only to the extent of their investment. And that holds true for any debt that we try to place as well. Their liability, there's no recourse to them as investors. Now,
how much skin in the game does the GP have in your funds?
In our funds, the GP, being us as the private investors, have 2% invested in the fund, and that amount has increased. Obviously, the quantum increases as we increase in size. So from the $70 million fund, we had 2%, and going up to the larger fund that we're targeting of $300 million, each of us will be contributing a total of 2%. Which is a meaningful amount to our personal budgets. It ensures that we have skin in the game. It's a little bit different than what you'd see for, let's say, a Brookfield or a larger entity that would have a pretty significant amount, like a 10% investment. But obviously our structure, this is a quantum that's palpable and makes the other investors feel as though we really are truly committed. Every time we review a transaction and bring it to our investment committee, we have to write a check as well. So we really dive in and have to have a very strong belief in the assets that we bring forward.
I guess you have, I guess that you have a stated strategy, or you limit yourself to a certain type of investments?
We do. So we are very value add focused. So I'll go here and sort of just go through the difference. The little play on words that we use in a lot of our marketing is value to the core. Many real estate investors over recent years have been so, I'd say, obsessed with core assets and acquiring stable, high quality, relatively lower yield assets and focusing on maybe downtown urban centers. What we do is value add. So we're a little bit different. We don't find assets that are in ideal locations or that are in ideal physical states, and we work to reposition them. Now, when I say not ideal locations, well, we try to focus on either Class C assets in Class A locations or Class A assets in Class C locations. So we have, over the past few years, focused on the suburbs. We do have a number of assets in downtown Toronto. But if you guys have sort of talked to others and heard anything about our market, that similar to any other urban center, downtown Toronto's office market is sitting at 0% vacancy. You don't even, you don't have to market space. You want space to go vacant pre-COVID. You're happy to have space go vacant because you know that tomorrow someone's going to walk in and take the space at 20% higher. There is literally no space in downtown Toronto. The suburbs, a little bit of a different story. Now, what we focus on is the right suburb. So we dive in very micro level and look at each and every aspect of a building. We understand the tenancies as we underwrite the assets. We dive in very deep and try to find ways of extracting value. So in this continuum of core to value add, or core to opportunistic, we play in the value add space, which is less risky than full on development, but certainly more risky, and as a result has higher returns compared to the core products. So as I said, what we really focus on and the pitch that we have to investors, what investors value, what tenants value, and brokers value about us is that we do dive in very deep. Our approach is to really dig deep into each and every asset. When we underwrite it, we often lease space out in our assets before we even own them, because that's our value add. So we're mindful of what's happening in the macro, but still very focused on micro specifics when it comes to the repositioning, and it differs in every single building.
Just a quick question of comprehension. So sometimes you're renting. Hold on. Sometimes you're renting out.
I was just expecting mine to do that today. So
the question is, sometimes you're renting out spaces that you are not yet possessing of, and then you are just making a kind of how should I put it, like a trial or like.
We would have a conditional deal. So here's an example. We would go through, one of the opportunities in our space is that buildings are just undermanaged. So sometimes buildings just, there's nothing really physically wrong with them and there's nothing locationally wrong with them. It's the current manager that's not doing a good job. And if in a scenario like that, as we're looking and underwriting an asset, we meet with tenants, we talk to tenants, we understand everything, we talk to the brokers who work with the tenants. And there have been moments where we've either met with a tenant who's there, who said, oh, finally somebody else coming, they'll have a broker, and we'll work with them and say, look, this is the deal that we'll do with you if we end up acquiring this building successfully. So it's a conditional deal for lease up. Similarly, we'll hear that a certain tenant is looking in a market, we'll find a vacant space, we'll match them up, and then say, and then say conditional on us actually moving forward with the transaction successfully, we'll work with you.
Yeah. Very interesting approach. So like that you can experience a bit and some properties prior committing and really getting into it. So very interesting approach.
We really dive into each asset. So what's a little bit unique is that when we focus on an acquisition, our acquisitions team doesn't say, here, this is the strategy, you guys pursue it, go ahead once we buy it. Instead, as we underwrite, actually all of the underwriting assumptions come to us through the operational team. The leasing team gives us the underwriting assumptions. The construction team will vet all of the physical aspects of the building and say, this is what makes sense, this is what doesn't. The property manager will come to us and say, oh, I've heard about this building, it has HVAC issues. Oh, I know this building, the building operator who's here. And so they all contribute from their own intel on the ground. And I think that's why, one of the things that we do, as I said, we're Toronto based, but more than that, while we have the ability to invest across Canada, the reality is pretty much everything that we do is right in our backyard. So we're Greater Toronto Area, GTA focused. And it makes sense to be when you're a value add player because you are hearing about all of these things happening right on the ground. So we know when there's a tenant who's unhappy in space. We know when there's a broker shopping around a tenant. We know when there's physical issues of the buildings. Our teams are part of all of these industry organizations like BOMA and NAOP, and they sort of tour buildings and are part of giving credits to buildings as we go through this classification of buildings that's so important. So we really get we try to identify little spots where we can add value, even if it's the most minute thing, like learning about the way that an HVAC system operates, knowing that it's, turned on at this time and this time, resulting in an extra 20 cents of operating costs, which means we can shift that 20 cents of operating cost into our net rent. So some of the things that we've done to try to differentiate ourselves, sustainability is a hugely important item. Again, pre-COVID, we introduced fitness facilities in all of our buildings. As I said, many of them are suburban assets, so we have to create communities, and that's what we really try to do. We've also done model suites, learning from some of the success of IWG and WeWork, and what made those co-working facilities so popular was the fact that it made occupying space so easy. And so we've actually spec'd a significant amount of model suites across our portfolio, building them out completely, because there's only so many different combinations of offices, open space, a cafeteria, and meeting rooms that you can do. And so we've sort of created a model suite program. We ended up actually building out an entire floor in one of our buildings as a model suite. A large tenant toured it and then said, can you do exactly this on the other 3 floors? So we tried to borrow kind of from the condo concept. And even at the start of COVID, having some of these model suites instantly available was actually quite helpful, because brokers reached out to us saying some of our clients are looking for space in the event that they have to separate and isolate. So can you, do you have any space available, 1,500 square feet, 2,000 square feet, to accommodate, some of our clients. So we, obviously not, I wouldn't say that there were thousands of those transactions, but it's one anecdotal sort of story that we have of kind of a positive thing that happened at the start of this.
So just to make sure that I understand your strategy, what you're saying is that you buy properties and then you upgrade them and change before you get to the point where you sell them at the end. They look very differently than what they used to when you first got them.
Exactly. And I will go through some case studies I have at the end of this, but yes, we'll take them, turn them around, either present them differently to the market, maybe not do anything physically to the building that's different at all, or other times we might do a pretty huge amount of things that are different in the building.
Emily, can I ask one more very quick question in terms of background? You spoke about different categories and you're in the value add category. Can you just give us a range of the cap rates we're talking about?
Sure. So and this is all kind of assuming that the world continues the way that the world has been.
Pre-COVID, yeah.
Pre-COVID, and assuming we all continue on in a happy post-apocalyptic world as opposed to dire circumstances. But typically, so when we're buying value add assets, the concept of cap rate is a little bit tricky because if you're acquiring a building that's 50% vacant or has rents that are 20% below market, cap rate is going to look unusually low. But let's talk about when stabilized. So the typical yield in our market for a top quality, highly sought after building in the downtown would be around, let's say on average, a 4 cap, possibly a little bit lower. A little bit lower if there's the upside potential in the rents, which everybody assumed was the case in the downtown because we're at zero vacancy. If you sort of shift that and look at suburban assets, good quality suburban asset would trade at around a 1 to 1.25 spread to, and that's sort of, again, stabilized, good quality asset. What we're buying is just sort of varies in a number of different ways. Again, we're IRR focused. We look at the overall repositioning plan, the timeline to get there, and then look at the exit, and assume, of course, as a prudent underwriter would assume, that the world is worse tomorrow. So in our underwriting, if a good quality suburban asset stabilized would sell today at a 6 cap, we would underwrite it at a 6.5 cap in 5 years when we go to sell it. So one of the other things, I had mentioned about sustainability, ESG is a huge topic right now in our market, everywhere, especially more than ever. ESG with COVID is coming to the forefront. And when you work with institutional investors, reporting, transparency, governance, those are all top priorities. And it's kind of nice that within our DNA as a company, we had that little bit of institutional background with that association that we originally had with Crown Life Insurance Company. So our CFO of our company was the CFO of a large Canadian insurance company. And a couple of our partners were actually directly involved in this Canadian insurance company. So that kind of instilled early on this very institutional governance focused model that was a nice contrast to the very entrepreneurial group of other partners who had originally started the company. Part of our ESG focus involves actually, reporting into indices that matter. So just as there is MSCI or IPD, for financial performance that institutional investors would look at and value a fund performance on. They also would look at our performance on a sustainability and governance perspective. And so this particular credit, GRESB, G-R-E-S-B, I'm not sure everybody says it differently, is basically it's the global real estate sustainability benchmark. It's the equivalent of MSCI, but it's in the sustainability front. And last year was our first year reporting to this benchmark, and we achieved 5 stars. 5 stars was the top score that you could get. And we ranked 7th out of 42 participants in North America. Now, those participants included the likes of Brookfield, Oxford, very large office players. And we thought that this was a really important thing to sort of reflect the fact that we are, we're repositioning our assets to make them institutional quality. We want to be able to sell to REITs, to institutions, to very high quality focused investors at the end of the day who have a second look at these assets that they had missed before. So this kind of benchmarking that we report to is very important, and will be rolling forward even more. This becomes, the questions that we're getting from investors are shifting more and more into this direction of ESG.
May I ask a question, please, regarding the sustainability benchmarks?
Yep.
Thank you. So there is a sustainability benchmark, which is quite new, which is the WELL Building Standard, and I don't see it on the list. So do you intend to follow that benchmark, or?
So we have actually pursued it, as well as Wired Score, which is a benchmark that addresses connectivity of buildings, which is especially important as we're all working from home and trying to connect to our office buildings. So these are things that we are pursuing. I don't believe that we have anything right now that's certified according to that, but we do have some things in the pipeline that are being reviewed. And I will say, right now, I think as we step back and see how will offices evolve going forward, right now in a post-COVID world, and how to really, all of those things I had talked about, the fitness facilities, the beautiful lobbies, all these things don't quite work now in the context of COVID. And we're very mindful of the fact that what we're doing in our buildings, we have to ensure that our tenants get whatever they need to bring their employees back to the buildings in a comfortable way. So health, wellness, safety of occupants, all of those things are sort of super important. And so having these benchmarks and credits to prove and sort of act as a signal are super important.
Okay, great, thank you.
One of the things I thought I'd do is share some case studies, just so that you can see the range of value add. This asset, 901 King Street West, is in the periphery of our downtown core. It's in it's a little bit west of the cool warehouse district, basically in Toronto. And when we had acquired this building, it was actually a very institutional looking building, concrete bunker that was built out as a bank's back office and had some of their call center facilities there. It really was out of place in this world that seemed to be much more not institutional. There's, you'd walk on the streets and see more of the tech media type tenants in that area. So what we had to do with this asset was really reposition it and deinstitutionalize it, is what we called what we did. So we had to take down this cold, all of the coldness of the building in the lobby and make it look as warm and cool as possible, to appeal to the new tenants that really should be coming to this building. Their alternative was brick and beam assets. And so they're looking at this as sort of this industrial type building that could accommodate them, but just looked very uncool at the time. So of course, the first thing that we did was take the lobby, the concierge desk or security desk, and turn it into a concierge desk with front and center a Mac computer. The biggest one we could find, because Mac computers look cool. And so the minute that we'd have building tours going through, you know, the people would walk in, we'd have construction all over with all of our signs showing what we're going to be doing. And of course, this cool Mac computer with a guy standing there that doesn't look like a security guard, but he looks like just a cool guy that you'd talk to at the coffee shop. So this particular building was very much about repositioning and rebranding. We also ended up getting a large architectural firm with whom we worked on the building, who we knew was looking at space at the time to occupy 2 floors within the building, and then we engaged them to do the repositioning. So we got to use their space as the sort of model suite. Every time we walked through the building, we'd show their awesome space, and it just really brought life to a building that was otherwise quite overlooked.
This is what we're seeing now.
This is what one area in the building does look like now. So this is the conference facility that we have within the building that can be used and accessed by the tenants. So what we also in the process achieved a LEED Silver certification and enhanced rents quite significantly, changed the tenant mix around. We were able to, we had some other assets that we knew tenants were leaving, and we managed to bring some of the space that they were moving out of one of our buildings into this building as well. And
I have a question about the LEED certification, because it involves a lot of relates to the air conditioning, the performance of the shell, the water treatment, and it's a really big investment for a building to get a LEED certification. And it says here you got like a bump for 50% from the rent. So I assume you took it into consideration, but it also means a longer renovation time.
Yep.
So the increase in rents is really impressive just for LEED Silver.
Now it happened, you know, obviously at the time as this happened, you know, we also rode a great rental market. So just as we were introducing this asset that many tenants had ignored, you know, what we offered was, it was still, overall occupancy costs were still less than if these tenants located in the core of the city. And the building itself, as I said, it was an institutional grade building. It was actually physically in amazing shape. There really wasn't a lot that we needed to do in terms of physical upgrades, which gave us the capacity to spend most of the money on these more cosmetic based upgrades. Another property. Now this is an asset that's in the suburbs of Toronto, very close to the airport, the GTA West, Greater Toronto Area West, which is a market that we have pretty strong belief in. Although everybody likes being downtown, there are many companies that need to be close to the airport, and also need to be close to where their clients are in the West End, and want to be located close to where their employees are. And the reality is that many employees don't necessarily live in downtown Toronto. So this asset happened to be a sale partial leaseback that we did. We had learned of AstraZeneca, Canadian global the Canadian headquarters of AstraZeneca, a pharmaceutical company. They wanted to divest of their 26-acre campus in the suburbs. They built this campus to an extremely high standard. Their office building rivaled, you know, any downtown. They actually used a very high-end architect to design their office building. The gallery and atrium of this building rivals, you know, the famous Calatrava Brookfield Place that we have here in Toronto. It's really quite stunning physically. The reality was they also had 500,000 other square feet of old, not quite great quality things on the property. That included an old manufacturing facility, an old warehousing facility, a building that they used for amenity space to hold their conferences in, a number of things that were no longer valid for them because they were actually shifting all of their production offshore. And all they needed on this campus was what they did in the deal is commit to a smaller amount, a portion of occupancy in the building just for their leasing or for their marketing and sales groups. And so you can imagine when we first toured this campus, 27-acre campus with 700,000 square feet of things on it, and only what was a 1,500 person campus had now dwindled to around 200 people. And so you can imagine how depressing it was to walk through this space. What we ended up doing is taking the entire site and shifting things around and chopping it up. The office building was very high quality. We moved them into a portion of it and then tried to reposition the rest of it. Again, learned of a tenant who was looking for space in the West End. This property had never before been marketed to third parties. It was always just occupied by the owner. And so when we introduced it to this broker and his client of a large construction company in the GTA, they were quite surprised and leased up a large portion of the remainder of the building. And then over time, we leased up a little bit of the rest of the vacancy. We then tore down one of the old manufacturing facilities and created extra parking, which we would need in order to accommodate all of these tenants, and that's the reality in a suburban location. We took another building that was an amenity building. We managed to get severance, so separated from the property with an appropriate amount of parking, and we actually sold it to orthopedic surgeons who were using the building for rehabilitation and minor day surgeries and checkups for their patients. And then this area that's pictured here is actually another manufacturing building that was attached to the main building. And we turned it into loft office space. So this is suburban loft office space. What it did was allow us to spread the costs, the operating costs of this building that had an atrium, as I said, that rivaled an atrium of any of any high-end Class A building in a downtown core. But we had a very little amount of office space to spread the cost of that atrium across. So by adding this extra warehouse that was attached to the building on the other side, knocking through the wall and integrating it with the office building, we actually were able to benefit in terms of net rents. So as I had said here, we ended up leasing out all of the different components. This space is what's known as flex office, this kind of loft office space. It's actually quite desirable, and now there's been a lot of talk about flex office space as something that a lot of companies are pursuing because you don't have to enter any common areas. You drive up, you park in front of your space, you walk in, and you have complete control over your own area. So I'm not sure that that's necessarily going to become the wave of the future in the Toronto office market, but it's in the right markets within the city, it really makes a lot of sense and attracts good quality tenants. For this property, I think our overall net IRR was around 30%, where a lot of the benefit came because of selling various components of the site once we were able to solve the jigsaw puzzle of the site. And what was interesting there is we are primarily office players. This property, when it was being marketed for sale, appealed to no one because there wasn't really enough office to be considered really an office asset. There was too much office for industrial groups to look at it. There was this excess of land that nobody knew what to do with. It was sort of in an unusual node. So while it's in the west end of the city, it was just a little bit removed from the actual office node in the west end. so it had a little bit of, it had so many hiccups on it that made it kind of interesting to us. Another thing that we have pursued and that is becoming more and more the nature of things that we'll see going forward are strategic partnerships. So we are office players. We know how to identify, as I said, we focus on every micro detail of an asset. And if we do that well, we do that only in one space, the commercial space. We are not condo developers. It would take too much energy, cost, and time to bring and incorporate condo development into our platform. And so what we'd rather do is align ourselves with groups that we see that are best in class players who are like-minded. So here we ended up doing a joint venture with, and prior to this, we had actually bid on several assets in conjunction with this condo developer in Toronto, who they've developed a number of assets. They have a similar model. And what they had shifted their model to more so was rezoning sites, as opposed to going through the full-on risk of development. So this site has a really significant office building on it and a bunch of excess land, most of which is used for parking for this office building. It's also right at the corner of, again, this one is in the West End of Huron, Ontario and Eglinton, right where there is going to be a transit stop in our expansion of transit. So this zone, this corner, has been identified as one that would allow for higher density. The reality with our zoning regulations here is that the site is zoned for employment. So you cannot eliminate this office building. If you did eliminate the office building, you'd have to replace it with one of equivalent size, which would be very costly. So we saw the office building and said, look, we can reposition this thing, which has not been managed well. And you guys work on the rezoning of the entire site. And we'll reposition the office, keeping in mind all of the phasing that's required for making this a viable development. Because right now, you know, many of the leases don't have demolition clauses. You'd have to move tenants around and pay very large penalties. So we were charged with dealing with the repositioning of the office, with our partner Plaza Corp doing the repositioning of the land. And as we stand today with all of our rezoning conversations, we would have the ability to probably add around 1.25 million square feet of residential, which would really appeal to a typical condo developer. It has several phases. It's in a zone that's very popular for, you know, our population growth comes from immigration. This is a zone that has a very large immigrant population, a lot of families. So the condo is being sort of planned in a way that we would maximize the sale revenue at the exit. We will not develop the condo, nor will Plaza Corp. We've agreed on a strategy, and the strategy is to sell the asset. Ultimately, in our market and with the costs of construction and risks that are involved in construction, what many developers are seeing is that you can achieve the same returns without the risk just by going through the rezoning process and turning the property through to somebody else and leaving them to benefit from any development upside.
So I'm not sure about that. I didn't really follow. I didn't understand the strategy. So we're talking about the complex here of the 3 high-rise buildings.
So it doesn't. This is just a rendering. The 3 high-rise buildings don't exist.
Right.
All that exists is this office building in the middle. And there was a bunch of retail pads scattered throughout the parking. What our latest rendering includes is sort of, you know, underground parking that's been relocated, and these 3 towers that can be developed in phases, with each phase sort of corresponding to different aspects of the land. So as you take out this area at the lower right, if you have to take that parking in order to develop this phase 1 property, that's not a problem, because we will have enhanced the parking on the other component of the site and built underground so that it can allow for parking. So we've contemplated this whole phasing and what a future developer would have to consider along the way. Because Plaza Corp, our partner, is so skilled at condo development, they know sort of what the different phases are and can identify, how to facilitate the development going forward for whoever the developer may be.
So you were saying that you would not be the developer.
No.
So what would be your added value to the project?
So our added value is, again, working in partnership with this condo group, we're repositioning the office to facilitate, to both make it look better so that we can have the development on site, and to facilitate the phasing plan. So that there's really nothing on it. The buyer can come and just hit the ground right away, start phase one. And that kind of removes any of these, over the past few years, what we've had in our market is many groups, developers willing to pay on a price per buildable foot basis just for the hope and dream of getting square feet. What we're giving them is the complete, here's the entire story. There's nothing left to the imagination. All you need to figure out is vet your underwriting numbers for the sale and however long it takes you to do the construction.
Did you split it 50-50 between you and the developer on the joint venture, considering that you're more focused on the office and he's more like the exterior part? How was your structure there?
So we talked about different things, and what we decided was the most fair thing is that we're equal partners completely on the entire site. And with independence regarding the investment parameters. So we have a business transaction that makes sense. They're not paying us any carry or performance fee. That has to do with our ownership. We're not paying them any carry or performance fee. That has to do with their ownership. What we're each trusting is that each of us will come to the table and contribute enough so that we both benefit from the carry at the end of the day. But we are 50-50 partners on the entire thing regardless. We're making money on the management of the building and the repositioning of the office. Similarly to, they're getting paid by us as they would by their investors for the time that they're spending on doing the management of the development.
Great, thanks.
No problem.
Emily, can I ask about the corona? I don't want to finish the time before we are speaking about the effects in the values, in the operation, in the deals that you think you will receive or see in the future.
Okay, for sure. No, and it's especially important because right now going forward, we are, obviously we're positive about the office story, the value add office story. We're raising another fund. We do have a good amount of interest from our existing investors who, are also willing to re-up their investment and believe in the story of office. I'll step back and sort of mention, the Toronto office market, the Greater Toronto area had very strong fundamentals going into COVID. Perhaps too strong. Downtown, at 0% vacancy, it was a very unbalanced market. In the suburbs were starting to benefit because there was no space downtown for groups to lease up. The question now is, well, we're all working from home. Do we even need to go into office space? And I think, there's a lot of people arguing about this and with different theories. I think ultimately, similar to what happened with 9/11, do we feel comfortable in a tall building? Do we want to go into a tall building and deal with, right now do we want to deal with elevators as opposed to being a security issue? It's more of a health safety issue. And I think the answer is ultimately we will return to normal when it comes to occupancy. We will not densify the spaces as much as we were. There were banks and other tenants who were, packing people into their space at 75 square foot a person. That's not conducive to social distancing. I think many firms are are saying we will resort to work from home permanently now, but ultimately, you do have to have the office is for collaboration, and where our office environment has got to is our employee base is a group of people who primarily live in 400 square foot condos, and they need the office in order to actually have space and work effectively and advance their careers. So as we're seeing this phase in the office, and many of what our operational teams are doing, working with our peers in the industry, are trying to find those ways that will make that phase in as comfortable as possible to those employees who come in to the offices. But what we'll see is likely a reduction in density, an increase in, as people separate themselves a little bit more. But what we need from the office is that common area space. And so I think office is going to be repositioned a little bit. And our job as office owners and managers is to help those tenants get that more of that kind of common area space that they need, that's open, healthy, safe, and provide them with that. So I think what we'll probably see is net no change in the demand in terms of office space, when it's a combination of those people who are increasing density. I don't think that they're going to end up leasing more space, and the people who are shifting to work from home and expanding common area space.
And how, as a managers, how would you now operate the high rise? Because you do have buildings that are more than 2 floors.
Yes, indeed. So, so we have, again, we're working with many of our peers in the industry through different organizations, and are implementing what is now seen as best practices. I guess in Israel, as you guys have opened, you're seeing what's happening in the buildings in terms of sort of managing people and the flow of people. So a lot of what we're doing involves communication with our tenants, signage, moving of people through buildings, limiting number of people in elevators. Yes, those will result in wait times in the lobby. And so we're sort of managing the flow of people again through the lobbies. And it's going to be a little bit of an experimentation right now to see how successful that is. And as I said before, like we don't want to, we spend so much of our energy thinking of how to create warm and inviting office environments. When you have a bunch of lines herding people as if they're cows, you feel anything but warm and welcomed. So our challenge as a manager is to figure out how to do that in a little bit of a different way. We're also actually going through our HVAC systems, upgrading and doing, I think there's UVC lighting retrofits that can be done to clean the air. We're increasing fresh air going through our buildings. Our tech guys can speak a lot better to how to that, but there are improvements physically that we're doing to our buildings. Where we see the opportunity here, specifically for our next fund, as we're looking for value add opportunities, is there are no doubts. So you asked about valuations. There's not really been evidence, because there's no transactions happening, that there will be any huge discounts in terms of opportunities to buy. The discount will likely arise only because there's been a loss of NOI because tenants have left. And it will also likely arise because people are going to underwrite a lot more risk and will underwrite the quality of the cash flow in place and be a little bit more conservative about it. But what we think the opportunity is here is in that repositioning. The skill set that we have is very focused on the not perfect situation, on identifying each and every way that we can optimize a building. And so on really underwriting tenant by tenant. And so that skill set we believe will serve us well going forward, where opportunities may arise in the office space. A strategy that's worked for us in the past has been to acquire 50% interest in buildings from sometimes institutional owners who have just lost their interest in a building. It's maybe sometimes too small for them to focus their team on. And so we've come in and said, look, we'll buy 50% interest. Here's our open book business plan. You have to buy into that, and then we'll sell the asset. You'll benefit from some of the upside going forward. And that's something that we think will be a good opportunity going forward, where some of the owners in our market may decide they're too focused on other things right now, and they don't want to focus on some of the less important assets in their portfolio. Instead of selling them, let's work with a group that has a track record, let them, benefit a little bit, and at least we'll have something on the table for us.
So I didn't completely understand whether you refer to the immediate future, or are you talking about the long run? Well, let me put it as a question mark. Do you expect to see long run effects on the market, on the specific markets where you're involved, or is it more of the short-term ones?
So our real estate market is in fairly good shape when it comes to the ownership. The opportunities that we look at, the larger sort of office buildings that would lie just below where a large scale institutional buyer would acquire. It's not the ma and pa opportunities, but like the $50 to $100 million, $150 million value asset. And so because they're not in the private space, they're typically owned by institutions that tend to be very conservative in their ownership. So it's unlikely that these are going to be groups that will sell in a distressed way. So I don't see these opportunities as necessarily coming up right away. I think it will take time to emerge as the tenants, the smaller businesses in those buildings roll out, and the owners find themselves with less cash flow from the buildings, and they look at them saying, what do we do with this now? So it's more an opportunity I see going forward for the fund that will take a little bit of time to come to play. Already we're starting to get, the first wave of opportunities that comes when there's any crisis, they tend to be the less quality opportunities. So, already we're having groups come to us, oh, well, we'll take a vendor take back. Isn't that generous of you? Because it's not financeable otherwise. Or we'll do this and that. Right now, this first wave of opportunities that's coming up are not things that we'd really want to look at. It's ones that we'd want to underwrite and see a good future for. So I think the quality of the assets in our portfolio is going to go up significantly in terms of their geographic location, physical nature, and it's more the time and energy spent to reposition that we'll focus on.
And how about, I'm sorry. How about structural changes in the market? You mentioned a little bit talking about office market. You expect in the long run, do you expect to see structural changes, or are these short-term, mid-term effects?
So our market is, we missed an entire development cycle. So we're extremely undersupplied in terms of the office space. Now, however, over the past few years, there's been a number of projects in our market, downtown specifically, that have been approved. And there's a huge wave of new developments coming into the market. All of those have been pre-leased. The bulk of them have been pre-leased to, a developer would not kickstart a project with, a poor quality tenant. So the bulk of them have been pre-leased to very high quality. Our market is mostly financial institutions. So the bulk of those have been pre-leased. I think we're sitting, as I said, at a 0% vacancy. I think there's going to be some hardship and owners are going to be surprised. It was very easy to lease up space before. And the only time we had that happy circumstance of, putting a sign up and saying space available, when we would close on an asset, we have broker tours, we have competitions, we have, fanfare, everything to attract brokers to our buildings. When we'd acquire an asset downtown, we didn't have to do a single thing. We would get phone calls off the hook. So I think the reality is right now, many owners are coming off of that in their mindset. You don't have to do anything. You'll just lease the space. And that mentality isn't going to work. Every asset is going to have to be treated like it was a suburban asset and is going to have a lot of thought and energy and time put into the building, whether it's downtown or not. And then, you know, so I do believe that there will be, you know, ultimately some increase in vacancy across the board.
Our time is almost up. If I can contribute my humble contribution from coming from the research world, you know, we've never experienced anything like this, maybe not in many decades. But overall, I can say that from previous trauma, relatively short memory. So I'm not too sure, you know, what this means about the current crisis. Nevertheless, it gives us, you know, at least we could be at least a little bit optimistic about the long run.
It's
Obviously,
true.
the short run, yeah.
Yeah, no, we do have a short, you know, just thinking back, you know, after 9/11, who thought that we would you know, who thought we would be occupying the buildings that we are? Who thought we would be, you know, and there's a sort of always been this you know, shock, and then you realize we return to normal. And I think going forward, what we're really thinking about as a company is, you know, back in February, when we were hearing of all of these incidents, you know, we sort of stood back and thought, we had this conference called Real Capital. It was a real estate and capital markets focused conference here in Toronto. The head of CB Richard Ellis Limited gave a presentation, and in his presentation, there was a little tiny footnote. You know, he was talking about our market, how booming it is on the office, industrial, residential side. It's just, you know, we're in the 10th inning, the 11th inning, trying to come up with, you know, this is a whole different game. And then tiny footnote, yeah, this sort of little known province has shut down completely in China that has a population that exceeds our population. And it was just, you know, a minor footnote. We all carried on our way, went to a cocktail party afterwards, had our schmooze, and, you know, of course, a month and a half later, we went on pause. And so going forward as a company, what we really want to think about, all of us as partners, and what we're telling all of our staff is, you know, what were we thinking then? What were we thinking that there would be no effect? And what will we be thinking the next time? Like, what is the next thing that's going to happen that we'll completely ignore? What shouldn't we ignore? Or that we'll overreact to, and try to have that sort of form our business decisions a little bit more. I will say we closed on an asset we closed on a property in the midst of this whole thing about on April 22nd. And I'd probably say had we known this would have happened, we probably wouldn't have bid on that asset in the first place. Now, ultimately, it's not a size that will impact our fund significantly. We believe in the repositioning plan we had. We underwrote it quite conservatively. Our lender was there for the closing on the same terms as at the very beginning. The rates ended up going down significantly, so we benefited compared to our underwriting. But still, had we known, you know, we bid on that asset around February, what were we thinking? Because had we known what could have transpired, we probably wouldn't have acquired this asset now. So I think that's going to be very much in our heads going forward, absolutely, for the first deal that we end up doing post-COVID. And many other groups are obviously thinking that way too.
This, I don't know if it's a pessimistic or optimistic note, but unfortunately, we're out of time. Emily, this was really wonderful. Thank you so much for joining us and for taking the time and talk to us. And we do hope very much to get to Toronto sooner the better, and maybe pay you a visit face to face.
You guys are more than
Thank you so
welcome.
much once again.
Yeah. Thank you very much. Really appreciated the questions and everything. If anybody has any questions or comments or anything that I didn't get into here, please feel free. Here's my email address. You can feel free to email me and reach out. And obviously, we're always happy when people come to town to tour people around any of our projects or buildings and meet. So we were hoping to have a trip out to Israel too, and that's possible in the near future as well. So I'll reach out to your group for sure as well once we come to town.
Please,
which will
please
happen.
do let us know when you come. We'll be looking forward to it, and please do let us know ahead of time. Thank you so much.
Thank you for your time.
Galia, thank you so much for organizing
Thank you,
this.
and thank you, Emily.